The bulls are attempting to stem October's decline before the month ends, but are still hesitant to put on risk ahead of Wednesday's Federal Reserve interest rate decision and commentary. 11 of 11 sectors closed green. Communication services led, and real estate lagged. Union strikes continue to make progress for workers. General Motors is the last of the big three automakers to reach a tentative deal with the United Auto Workers UAW union, coming days after Stellantis and Ford reached agreements. Meanwhile, the Great Lakes shipping artery will start to function again after Canadian workers reached a deal with St. Lawrence Seaway Management. Western Digital jumped 7% after announcing that it will separate its hard drive and flash memory businesses via a spin-off. The company acquired flash memory manufacturer SanDisk for $19 billion in 2016, with this separation essentially reversing that merger in the second half of 2024. Icon Enterprises remains on the ropes, hitting 19-year lows, ahead of its third-quarter earnings release on Friday before the opening bell. Its downtrend began earlier this year when Hindenburg Research published a short-selling report on the company, accusing it of overstating its value and paying an unsustainable dividend. McDonald's shares popped after its earnings and revenue topped expectations, with a roughly 10% price increase in 2023 helping drive the results. The fast food chain is seeing continued pressure on lower-income consumers with $45,000 per year or lower, but is gaining share with middle and high income as they trade down to cheaper dining options. Commercial real estate right, Realty Income Corp, agreed to acquire Spirit Realty Capital for $5.3 billion in an all-stock transaction. This will further diversify its tenant base at a time when commercial real estate remains under pressure. HSBC shares fell 2% despite its after-tax profit, surging 235% year-over-year, and the bank announcing a $3 billion share buyback. Popular fintech giant SOFI Technologies posted stronger than expected results and lifted its forecast. However, that wasn't enough for the stock to hold on to early gains. Its efforts to attract and retain new money appear to be working, with more than half of newly funded SOFI money accounts setting up direct deposit by the end of their first month. That stickier money drives debit transaction volume and strong cross-buy trends with its lending and other financial services products. And with FDIC insurance of up to $2 million, nearly 98% of deposits were fully insured at quarter end. Its third quarter net loss grew to 29 cents per share, vis the 8 cents loss per share analysts anticipated. However, it said that if it excluded the impact of non-cash impairment charges, that loss would have been only 3 cents per share. Management reiterated its confidence in achieving positive GAAP net income in the fourth quarter, and adjusted EBITDA of $98 million was its highest ever, topping the $65 million analysts expected. Overall, executives remained optimistic about balancing growth, investment, and profitability. They lifted their full-year adjusted net revenue guidance range to $2.045 to $2.065 billion, topping estimates of $2.026 billion. Their forecasted $386 to $396 million in full-year adjusted EBITDA exceeded analyst estimates of $344 million. Despite that, investors' concerns boil down to a few key themes. The first is that the current environment for banks is a challenging one, as higher interest rates have both positives and negatives. The second major concern is that some analysts do not believe the company will achieve its GAAP profitability targets and generate the cash needed to fund its growth. Since the company is still in investment mode, that means it may have to take on higher interest debt. Lastly, some on Wall Street do not believe the online banking model is a viable one long-term. For now, the company is focused primarily on wealthy consumers, earning over $100,000 per year. But concerns are that it could limit its ability to grow market share, and if it needs to expand that core group of customers down the income spectrum, they'll be playing a very different and potentially more difficult ballgame. That's why the stock's valuation remains suppressed, despite seemingly strong results. SOFI shares were up as much as 15%, but faded throughout the day to close slightly green. Next, image sharing and social media site Pinterest topped third quarter estimates. Its adjusted earnings per share of 28 cents on revenues of $763.2 million beat the 20 cents and $743.5 million anticipated by analysts. Global monthly active users also saw substantial gains, rising 8% year-over-year to 482 million, vs the 473 million expected. Meanwhile, average revenue per user of $1.61 beat estimates by 2 cents. The company also managed to keep expenses in check, rising just 2% to $768.2 million. It's anticipating fourth quarter 2023 non-GAAP operating expenses will fall 9% to 13% year-over-year. The company continues to lean into its differentiators as a visual search, discovery, and shopping platform, delivering stronger results for advertisers. It anticipates its position in the market will continue yielding results, seeing fourth quarter revenue growth of 11% to 13% year-over-year versus 11.3% estimates. Overall, shareholders were happy that advertising on the platform is holding up well despite several industry headwinds weighing on competitors. PIN shares rose 14% today. Meanwhile, American education technology company CHGG once again failed to impress. The stock experienced a sharp decline in late 2021 and early 2022. As the pandemic-era growth it experienced slowed significantly. It also dropped heavily earlier this year after it warned that ChatGPT and other generative AI tools materially impacted its market share. Most recently, the stock has been on investors' radars as it looks to stabilize at its post-IPO price in the high single digits. However, overall concerns remain, despite the company posting better than expected third quarter results and meeting guidance. The company's service subscribers fell roughly 8% year-over-year to 4.4 million, with free cash flow down 83% quarter-over-quarter to $9.37 million. Investors remain skeptical that the company can transform itself into the hyper-personalized, on-demand tool that its customers expect in today's day and age. CHGG shares fell nearly 5% after hours, eliminating their regular session gains.